Have you ever wondered how a company's value is actually measured? Or what investors really mean when they talk about market value or market cap? In today's video, we're breaking down exactly what market value is, how it's calculated, and why it's so important, especially if you're thinking about investing. Let's make sense of these big financial terms in a way that actually makes sense. At its core, market value is the price an asset would sell for on the open market. That could be a car, a house, or a company's stock. It's based on what buyers are willing to pay and what sellers are willing to accept. Simple as that. In the stock market, when we say a company's market value, we're often referring to market capitalization, or market cap for short. So what exactly is market cap? It's the total dollar value of all a company's outstanding shares. To calculate it, you multiply the current share price by the number of shares that are available to the public. For example, if a company has 20 million shares and each is worth $100, its market cap is $2 billion. Now compare that to another company with a share price of $1,000, but only 10,000 shares outstanding. Its market cap is just $10 million, much smaller. So you see, a higher stock price doesn't always mean a bigger company. Why does this matter to you as an investor? Because market cap gives you a snapshot of a company's size and helps you compare it to other businesses. It's also a key factor in risk assessment. Large cap companies, worth over $10 billion, tend to be more stable but offer slower growth. Mid-cap and small-cap companies might be more volatile, but they can also offer more upside potential. Market cap is also crucial during acquisitions. It helps buyers determine whether a company is a good value or overpriced. Once a company goes public, its share price is driven by supply and demand, making market cap a real-time estimate of how much the market thinks that company is worth. Understanding market value and market cap helps you make smarter, more informed investment decisions. So next time you're researching a company, don't just look at the stock price. Look at the full picture. Have you ever heard someone talk about a company as outstanding shares and wondered what that really means? Whether you're investing in stocks or just want to understand how companies are valued, this is something you need to know. In this video, we're breaking down what outstanding shares are, why they matter, and how to find them, all in simple, everyday language. Let's get started. Part 1. What are outstanding shares? Outstanding shares are the total number of a company's stock shares that are currently owned by investors, including individuals, big institutions, and even the company's own insiders and officers. Think of them as the total slices of the company that are currently out in the world. They do not include the shares a company has bought back and is holding in its treasury. You all usually see outstanding shares listed on a company's balance sheet under capital stock. Let's break down a practical example using Company ABC, a retail company that sells cell phones. They recently issued 26,900 shares through an IPO. They also gave 3,000 shares each to 2 managing directors and held back 5,600 shares as treasury stock. John, an investor, wants to figure out the company's market cap and earnings per share. First, he calculates the outstanding shares like this. 26,900, 5,600, 2 multiply 3,000. There were 15,300 shares outstanding. The current stock price is $28.67, so the market capitalization is 15,300 multiply 28.67, 438,650. Now the company's net income is $14,500. So the earnings per share, EPS, is 51. 14,500 divided 15,300 offered 0.95. 3 months later, the company buys back 1,000 shares. That brings the outstanding shares down to 14,300. The new stock price is $27.49, so the new market cap is 14,300 multiply 27.49, or 393,107. Fewer shares means higher EPS. So now, 14,500 divide 14,300 bar 101. That's a 6.89% increase in EPS just by reducing the number of shares. This shows how outstanding shares directly affect both a company's value and investor returns. 2. Why outstanding shares matter. Outstanding shares are more than just a number. They help investors calculate some of the most important financial metrics like market capitalization, that's share price multiplied by outstanding shares, earnings per share, EPS, cash flow, per share, CFPS. These numbers give investors a snapshot of a company's size, profitability, and value. The more accurate the share count, the better your analysis. Part 3. How the number can change. Now, here's the catch. The number of outstanding shares isn't fixed. It can go up or down based on what the company does. If a company issues new shares to raise money or to reward employees with stock options, the number goes up. If the company buys back shares, the number goes down. It can also change during things like stock splits, which increase shares but lower price. Reverse stock splits, which do the opposite. These changes affect how a company is valued, so investors always keep an eye on them. Part 4. Where to find outstanding shares. So where can you actually find this number? For publicly traded companies, it's usually listed in the investor relations section of their website or on stock exchange websites like the NYSE, NASDAQ, or even Yahoo Finance. You'll also find it in financial reports, especially the balance sheet or the annual 10K filing. Make sure to check that it's up to date, since the number can change over time. To wrap it up, outstanding shares tell you how much of a company is truly in public hands. They help calculate market value and guide smart investment decisions. Next time you're researching a stock, don't just look at the price. Check how many shares are in play. That one number can tell you a lot. Have you ever wondered why some stocks seem overpriced while others look like a bargain? It all comes down to two key ideas: market value and intrinsic value. Understanding the difference between them can help you avoid risky investments and spot hidden gems. Let's break this down in a way anyone can understand. 1. What market value tells you. Market value is simply the current price of a company's stock. It's the price you see on the stock exchange, like the NYSE or NASDAQ, based on what buyers are willing to pay and sellers are willing to accept. But market value isn't fixed. It fluctuates a lot over time. During recessions, market values drop in what's called a bear market. During economic growth, market values rise. That's a bull market. In short, market value reflects investor confidence and the state of the economy. 2. What is intrinsic value? Intrinsic value is different. It's an estimate of what a company is truly worth based on its future earnings, assets, and financial performance. It is not found on the stock exchange. It is calculated by investment analysts using models like discounted cash flow or book value. Think of it as the value the company should be trading at, based on its real business potential, not just market hype. 3. Comparing the two. So what happens when market value and intrinsic value don't match? If the market price is higher than the intrinsic value, the stock is considered overvalued. This might mean investors are expecting big future profits, or it could be overpriced based on hype. If the market price is lower than the intrinsic value, it's called undervalued. That means the company might be stronger than the market believes, and it could be a buying opportunity. This difference is often measured by the price-to-book (PB) ratio. Price, what investors are paying now. Book value, what the company is worth on paper if it were liquidated. 4. How to find market and intrinsic value. You can find a stock's market value online or in financial apps. It's updated in real time during trading hours. The closing price each day tells you the latest value. But intrinsic value isn't listed. You have to calculate it. Analysts use future cash flow projections, subtract liabilities from assets, and apply complex models. Sites like Yahoo Finance or your brokerage platform may show estimates. But remember, every analyst has their own method. 5. Final thoughts. Why this matters. Understanding market value versus intrinsic value helps you invest smarter. It tells you when a stock might be overhyped or when a good company is being overlooked. It's a tool for identifying value stocks, avoiding bubbles, and making confident decisions, even when the market gets emotional. So before you invest, always ask, is this stock really worth what I'm paying?